disclaimer, in this episode, we are going to be using the F word. You might not be ready for it. Here we go. It's the Cash Compound Podcast. J-Do and
Jonah.
We are here back in studio talking about one of our newest presentations. If you have been around our channel very much, we're doing code cracking cash flow types of things with our friends. Not that hood rat stuff anymore. And this time it's a little bit more hood rat than normal. We're going to use the F word, Jonah.
Yeah, so here's what happens. More often than not, just because of the personalities we have and the people that we've rubbed shoulders with, the YouTube channels, the Instagram channels, the social media channels, we get asked to speak, right?
Yeah.
They're going to say, hey, we're doing an event. We're really interested in you speaking. We've done all sorts of events. We've done events for...
real estate.
Yeah.
RIAs, birthday parties, barbecues.
Yep. Saturday morning get-togethers, in the living room get-togethers,
in the house, home meetings, Zoom meetings, of course.
We've done meetings for clients. We've done meetings for advisors.
Yeah.
We've given educational talks. We've given just perspective talks. And
historical talk.
Yeah, and so this time it was an educational talk for a group of clients.
Yeah.
And so that's where we were this last time. So we've got a couple different keynotes, like you just mentioned. Also, if you ever want to know where we're going to be at, you should just visit thebankingbros.com/events. That'll tell you all of where we're going to be. For instance, this upcoming week, by the time that you're watching this video, you should know that I'll be headed to Los Angeles to do a client event, actually. So if you're
Tell us
in the
about
LA
those folks,
area,
because they put you in the magazine, man.
They did, actually. There's a really cool... Maybe we should make a video on that. I should flip the magazine open and read, right? But anyway, yeah, there's a real estate group. They're called Realty 411, who hosts events all over the country. And we've been speaking at those events maybe for like a year and a half now. I'm no good at time. I never pay attention.
You're not.
And so
it's not that you're not good at it.
I don't pay attention.
Yeah, it's not a thing that like triggers you. Me, it does all the time. I know time.
I never pay attention. So how long you been speaking in Realty 401? I have no idea. But it might be 10 events now.
Yeah. So Realty 411, if you do see Realty 411, want to subscribe to their channels or join us at some of the events, we're often on the docket. You go to a little bit more. It's 2/3 you, 1/3 me.
Yep.
But they've been from Philly to Texas to Dallas to LA. You've been to the LA one 3 times, 4 times.
Yep.
Things
I
like that.
I did a New Jersey with them once or twice.
Yeah.
And some other stuff. There was a New York, but then they canceled it. I wanted the New York. New York is a fun city, but
it is.
Anyway, so yeah, I'll be there. We just did a podcast episode actually on one of the events that we just finished doing in Nashville, Tennessee. So that was another
Vegas,
cool
baby.
event. In between that last episode and this episode that we're filming now, there was also a Jacksonville, Florida event. So all that to say, again, if you want to figure out where we're going to be, it's thebankingbros.com/events. If you want us to speak at your event, you can find that on thebankingbros.com also. Or if you've got our contact information, just send us a text, shoot us a text. And we'll walk you through how that works, getting us on stage at your event. A lot of times we're going to do that pro bono, depending on the situation. So that's really cool.
It's always custom for you. Well, you've got one coming up, Orlando, before the end of the month. Jacksonville, Florida.
5 days away.
So you got to, you got to tell people what's up.
Well, again, by the time they're watching this episode, it will have already happened.
Well, watch it early. Y'all need to watch faster.
Right.
Keep up.
Subscribe to the future YouTube. You get all the videos we haven't put out yet.
Yeah, early edition. You remember that show?
Yeah, I do. With the football coach from Friday Night Lights.
Yes. Where the paper came a day in advance. Shout out. Put it in the comments if you remember early edition. That was my show.
It was a good show. Friday Night Lights is better for that actor, but it was a good show.
Okay. So, ladies and gentlemen, the F word we're going to get into at the Money Multiplier Mastermind event 2024. We brought a new keynote experience, and it's really based on one of the key phrases that Nelson Nash came to us with in his book, Becoming Your Own Banker. The key phrase is you finance everything you buy. All right, so the F word, now that you've sent the kids off to bed, is finance or finance, depending on where you're from.
I always say finance, right? So, but I have heard people say finance. Sure.
So I think in the Indianapolis area, in the Midwest, they call that, the Great Plains, I think it's often finance. So what we need to help people understand is, unless you understand the problem, the solution won't matter to you. So many of you out there are hung up in the hype of the numbers, and that's going to lead you toward like investment and return type thinking. That's not really what we're talking about here. When we talk about the infinite banking concept, we want to remind you, throw the word concept on the end of your searches online for infinite banking. Throw the word concept on it so you can go to the source and understand what the problem is before you try to reach for the solution. You don't know the problem. The solution won't mean anything for you. And Nelson said that best. So, Jonah, you finance everything you buy. You either give up the money and have to pay interest on things that you want by financing third party, or you lose the money you could have kept.
Yeah.
Help people understand that a little bit.
That's a big deal because it took me a long time to wrap my head around that.
Right.
I did not grow up with a big financial knowledge. I did take a few business and finance classes in school, but I wasn't really paying attention in school that much, to be honest with you. I was playing basketball and you know, having a girlfriend and things like that. I just wasn't paying attention, right? So what that means to you is what we have to talk about always, we have to talk about cash. Everybody wants to talk about using cash. And there's a big, internet personality these days, used to be a radio personality that talks about using cash. He says cash is king. But the reality of the situation is when you use your cash, you do not have the money anymore. You have the thing that the cash bought, but you don't have the cash. And the money, the cash, is what can grow, right? You cannot earn interest on the cash, the money, if you do not have it. And now that you have the thing, pretend it's the cell phone, right? The cell phone does not earn me anything. So I'm now, if I had the $1,000 still, I could place it somewhere that would earn. So that $1,000 can turn into more over time. But as soon as I give it away for the cell phone, I cannot earn anything.
Gone.
It's called opportunity cost. So I've just lost the potential to make money if I always use cash. I know we talked about a cell phone. That's a really small purchase, but expand your thinking a little bit, right? Talk about the vehicle, the $50,000 car, the $200,000 or $300,000 house using cash. There's a big personality out there that says give up $200,000 or $300,000. You should own this outright. Use your cash. And I'm here to tell you, if you've got $300,000 of cash, you can make a significant amount of money by keeping it.
Let's go.
I'm not saying you don't get a house, but I'm saying maybe it's worth financing a house to keep all the money and go make more elsewhere.
Okay.
Right?
Jonah, we got to lay it down for them because they're going to get lost. If you're new to enjoying what we do here at the Cash Compound, we are going to introduce you to a process and a product that you can keep the money with. So you're going to have to go out and buy the things. Jonah, you got 5 big basics, as we called them. We're going to walk through, yes?
Yeah, let's do it.
Okay, 5 big basics. Most everybody is going to experience these in middle-class families in America, North America, U.S. and Canada. And these 5 big basics, we're going to show you how to finance. Use the F word. Finance them traditionally through probably the means of what you're currently doing and how you're paying for them, or utilizing the product and process of infinite banking concept.
There we go.
All right.
Let's see what the math says. So one of the first things we want to finance is a vehicle. Almost everybody's got to buy a car at some point or another. It's really hard to get around unless you're in the very big cities that the USA has to offer without a vehicle. We are not in one of those cities and not actually even super close to a city that has got a great public transportation system that you could possibly go without a car. So let's talk about financing a vehicle. The first thing that we want to do is kind of understand what the traditional banks are going to charge you if you finance the car. So I've got a little screenshot to put up here. This is from our friends over at one of the big financial institutions. If we were to go ask for a $55,000 car from them, and we wanted that loan for about 6 years, which is pretty standard these days, 72 months, it looks like they're going to charge us almost 12.5%, and our monthly payment's going to be almost $954. So what we want to do is do some math on those exact numbers there. So it's a $55,000 car. Our rate is 7.2. The time period is 6 years or 72 months. What that means for you is that your total cost out of pocket, if you finance this vehicle, is of course the $55,000
Principal
that
purchase.
you must pay back because that was the price of the car, plus an additional $13,737.68 of interest. Now, of course, let's talk about the cash purchase as well. If you go buy the car in cash, you've given up the $55,000 still, just like in the finance example. You've got to give them the $55,000 if you want the car. Of course, the price of the car. And now I have no money to be able to earn, right? Let's
money is gone.
Let's dissect very independently the transactions. What I don't want you to be thinking at home is, well, I'll just earn more money, right? Oh, I've got other money. No. You had $55,000, or you were going to earn $55,000 with financing, but it is now earmarked for someone else. You've got to give it to them.
Yes.
Right?
Now remember, that $13,700 that you've paid is someone else's passive income.
Yeah.
They've made that as a profit, and you've lost it. It's gone from your family forever. You did have to capitalize this opportunity because you had to make money somewhere, but it left your family. It went somewhere else. So this is, Jonah, the other thing that we've got to help people, I think we just need a disclaimer and say this from time to time, is this is normal. This is what you're doing. We're not saying don't get a car. We're not saying that you did something dumb. We're just saying this is normal. But is there an alternative? That's the question.
Yeah. So we believe there is. We believe that alternative is infinite banking, and we'll show you some numbers to prove it. So let's go use our infinite banking policy to purchase the same $55,000 vehicle. Now, anytime that you take a loan from your infinite banking policy, it is in fact a loan, not a withdrawal, and this is really, really important. See, we teach you all the time about our 3-cup setup. And in our 3-cup setup, the middle cup, or the green cup, represents cash value. Cash value is equity of the life insurance policy as a whole and the death benefit that the insurance company promises to your family after you're gone. So by taking the $55,000 from a policy that you have built up, it is in fact a loan. And we always say, just like Nelson, that we should be an honest banker. And if you're going to be an honest banker, that means
you should pay back the loan with interest and potentially the same or better terms because it's coming back to you.
So in our example here, what we want to do is just use the same terms. So 7.2%. Our friends over at the bank, they literally have a website. You can punch in, if you want to buy this car, this is exactly what we'll charge you. So let's use the same terms. Let's use the same length of time. What that means is our total cost this time is the same $55,000 for the car. Like that's the car that we bought. But this time the interest of $13,737 will be paid back into a policy, a private banking system, an infinite banking policy that we own and control, which means we keep the money instead of giving it to the third party, right?
Yep.
Now, the insurance company is going to charge you a little bit of interest for taking the loan in the first place.
Remember, we are borrowing against the value of our policy, ladies and gentlemen. Cash value is a number. It's not really money, actually, but we can borrow the number out in real money. We are borrowing. We're going to return that to them, and there's going to be a simple interest that is calculated for the borrowing, the privilege of being able to borrow and be able to utilize that money. So
I've calculated that cost pretty generically. Every insurance company charges a little bit different. So if you've got an infinite banking policy, just look for your interest charge. It's no big deal. But I've calculated it as a kind of a flat rate here at about 5%. So it's $8,775 of charged interest to the insurance company. But that gives us a total of $59,962.55. Let me explain. The $55,000 that was borrowed from the private banking institution that I own and control, when I repay that plus interest, just like I do if I finance through Wells Fargo or Bank of America or CarMax, whatever banking financial institution they're using, right?
Right.
I still have to give them back $55,000 plus extra. So it's the same thing that I did in this scenario, but I was the banking institution. So I got all the money plus the additional, which means that I kept $59,962. So instead of just giving away $13,737, which is what normal people do.
Right.
We finance cars, we finance houses. We give up $13,000. This time I keep $59,962.15 and the car.
Okay, so you guys got it? We now have these dollars still within our control. We have not given them away to a third party. They're still within our system of this whole infinite banking policy that we have, and we've got the car, so we didn't lose out on the opportunity of being able to get places for the last 6 years.
There you go.
All right, that's big basic number one. Everyone's got cars. How about the business owners out there, Jonah? What do you have for them?
There's a lot of business owners out there, and a lot of times business owners need to finance equipment, right? So I took this screenshot from our friends. I believe the red letters give it away, right? These are the friends over at Wells Fargo.
Wells Fargo.
And they say they'll give you some equipment loans, but they've got some stipulations, which is fun, right? You got to have at least $250,000 in annual revenue. You got to be in business for 2 years, and I'm sure they want every piece of paper your business has ever been sent in the mail box, and right?
Ever
ridiculous to go to these banks. But a lot of people do, and they try to get equipment loans. Let's pretend this is equipment loan for $40,000 using Wells Fargo's terms at 6.25%, sorry. Time period of 60 months. What that means is your total cost is going to be the $40,000 of principal, but $6,672 of interest. So now that's what the average person does. They say, I really need the equipment. I am okay with a big payment every single month paying back to Wells Fargo. I know that Wells Fargo is earning $6,000 off me, but it's okay because I really needed the equipment.
On top of that, we're in business, right? We can't actually pay cash for everything that we need. We don't have a cash reserve saved up of tens of millions of dollars. If we did, we probably wouldn't be in business. We'd probably be on the beach.
Right.
So we are going to finance this, and we typically think about the rate and not the interest number.
That's right.
Not the total volume there.
Not the total volume, just about the number.
Yep, $6,600 is going off to Wells Fargo.
I'm sure we've got people on our podcast right now that are saying, I'd never take an equipment loan for 6.5%. They're missing the point. Right?
They are missing the point. They also probably are not in business. They probably think it's just the rate. They probably also think that they're going to always have enough cash for everything that they want to purchase. And I don't even think that's applicable in business most of the time.
Most of the time. Let's see what we can do if we take this equipment loan from our private financing institution, our banks. It's the same $40,000 that we needed for the equipment, but and we need to pay it back. So let's use the same rate Wells Fargo was going to charge in the same amount of time. Here's what our total cost comes out to. The same $40,000 for the equipment. We bought the same thing. Right? The same $6,678 of interest because we're going to use the same terms and the same length of time. We're also going to give the insurance company the charged interest because we did loan from the cash values of the policy, but we finished with a total of $41,387.
Okay.
Here's the example. Here's the equation. You either finance through the conventional means and you get your equipment, but you have to pay extra $6,678. Or you finance through the private means. You get your equipment and you keep $41,387. It is a $48,000 swing by financing privately as opposed to doing it publicly or conventionally.
Okay.
That's what I don't think people realize. People go, oh, the insurance company's going to charge me some interest. It's the worst deal ever.
Why would I borrow my own money? That's what they actually say, Jonah.
Right.
Why would I borrow my own money? Remember, we're borrowing against the policy. We're borrowing against the money we bought. So if you change the way you think, how you think matters. When you put in $1 and you buy a bunch of money from the insurance company that must be paid later, we're actually borrowing against their money. So at the same time, Jonah's proving to you with the math how it actually works out and what we keep throughout this process of financing things. We've got to buy things, folks. So we got to keep the money flowing. Let's keep the dice rolling, Jonah, and go through another one of the big basics.
Yeah, let's talk about a house. lot of people purchase houses, right? So let's do the same. Let's do it through conventional means. I've got a nice screenshot from another big financial institution. They give us some heads up right here at the top of the screen. So if you were looking for a home in Austin, Texas of about $400,000, one, they're going to require you to give away 20%, $80,000. You used to have it last week. Now you don't. Right? That's the opportunity cost we're talking about. Right? But not only that, as soon as you do that, if you're looking at maybe a 30-year fixed rate, you can see that at the bottom, we've got an APR of around 6.389%. So let's finance that deal. Let's go to the finance institution and say, we'll take it. We'll take that $400,000 at 6.389 for 360 months or 30 years. Here's what that means. Your principal on your house is $400,000. Of course, that's what you purchased, but your interest is $309. Hold on a second. That's like another house.
You paid for the house twice. Everybody needs to understand that the math says if you have a 5 to about 6% interest on your house loan, you're going to pay for that house twice. Just so you know. All right.
Not only that, interest, mortgages front load all the interest. You pay so much stinking interest in the first 7 years of that house. Anyway, that's
y'all know, but you don't think about it because it's all about the rate to you and not the volume. We're here to talk a little bit more about volume to help you have a better perspective on how to keep the volume.
People say, no, my house interest rate is 2%, 3%. I've got a great rate. I'd never pay it off. And I go, you're still giving them an extra $200,000, $300,000.
What if there are alternatives? What if there are alternatives to keep the money? That's what we want to challenge you with, everybody. Not the fact that you shouldn't live in the house, not the fact that you should rent all of your rooms. That's not the point. But what if you could keep the money?
There we go. Let's finance this privately. That's $400,000 from our infinite banking policy. Again, you had to have it built up in order to take the loan. But once we take the loan, we want to repay the loan, and we'll use the same rates that the lovely conventional bank has already provided right on their front page. That's 6.389% for 360 months. So here's our total cost now. Our principal is the same. It's the same house. We need to live there. We bought it. Now our interest of $399,000. You can see it on the screen. I turned it green for all those who are not watching. $399,000 of interest is now green. Green means go. Green means you get to keep it. That means our charged interest to the insurance company is about $300,000, and our total is $501,000. Here's what I mean. Finance your home through conventional means, you will give the mortgage company an additional $399,000. Finance your home through private financing, you will keep $501,000. That is a $900,000 swing positively toward you, your wind current coming in, getting behind you, pushing you forward because you did the financing privately. And that's what a lot of people miss.
Run with the wind, bullseye.
They
Isn't
miss
that what
it,
Woody said?
Right? They miss it.
Okay.
Man.
All right. So, Jonah, there's a couple of big basics out there. A lot of people who look at infinite banking, who have heard about infinite banking, who study infinite banking, are actually thinking that this is the way to get a better investment going. So let's look at one of those big basic. It's maybe for a lot of people who listen to us, it is a basic. For most people, they're probably not in investments, but let's look at an investment.
Sure, let's do it. So here's an investment that we actually even did in our town. I know it's a little hard to read, especially if you're watching on YouTube on the screen. So I'll give you the terms. It was a year term. $100,000 is what they needed to flip a house, and they were going to pay 15%. It's pretty easy.
To us for lending them the money.
Easy. So here's our options. Of course, maybe we need to go finance this with something like a home equity line of credit. I've talked to a few people recently. Talked to a gentleman in our town yesterday. He's got a home equity line of credit at 9%. That's what we decided, and that's what the banks say they have. That's what they're offering. You just saw that. That's what we decided to put on this policy. So it's $100,000 through a home equity at 9.7% for just 1 year, which means, pretty easy math, your total cost is the principal of $100 plus, of course, the $9,700. $9,700 of interest. Let's do that same deal, same terms, same length of time, privately.
Now, Jonah, let's also throw in here before we end, we would be remiss, as they say, to not point out that when you're borrowing against your policy, there is no paperwork.
Yeah.
Okay, so
a
when
big
we
deal.
call into the insurance company, remember, this is equity on something they owe you, ladies and gentlemen. They owe you a death benefit. Cash value is an amount that you could borrow against, so we're just go take it out of that green cup. And when we call them, depending on the number, they may ask you to verify who you are, like they do everywhere else.
That's right.
And then they'll say, where do you want the money? Do you want it wired because you need it immediately? It's an investment. Maybe we need it wired.
Yeah.
Okay.
A lot of times for investments, you got to wire it.
Yeah,
Absolutely.
We need a wire. Number 2, do you want a direct deposit? Put your account on file with us, fill out that one cheater, and tell us where it's supposed to go. Account, routing, direct deposit. Or number 3, check in the mail.
There you go.
That's it, ladies and gentlemen. Sometimes you have to do one extra piece of paper if you're getting maybe above $5,000, $10,000, $15,000. But that's it. There is no qualification. There is no credit check. It doesn't ping anything on your report. This is positive equity in an asset that's private. And so there is no rigmarole.
Yeah. A lot of people don't realize how important that is.
Yeah.
I don't know the last time that you went to the bank and you tried to get a loan, but the amount of questions, the amount of paperwork, the amount of ridiculousness they put you through is legitimately absolutely wild. And so that's one of my favorite parts about taking private loans from the infinite banking policy. 2 questions, right?
Yeah. Well, yeah.
How much
How much and where do you want it?
and where do you want it, right?
So sometimes I get, Jonah, I've done this before. The DMV gives me as much anxiety as the bank loan because I know the first time I show up to sit down with the banker and get that little office corner spot with 20 minutes with him or her, I know I didn't bring everything.
yeah.
I hate the idea that I brought a shoebox. One time I brought a shoebox. This is back in the day. Brought a shoebox full of stuff. I'm talking the water bill.
Still wasn't right.
Yeah, and I was like, I still meant my report card.
Yeah.
You know, my GPA. Or was like, what? Nope, didn't do it. So you don't have to go through that with the insurance company. Verify who you are. Get it down on paper once for a direct deposit, and let's go.
Yeah, there you go. So back to our example, let's do the same deal, right? It's the same terms. It's the same length of time as a HELOC would charge us. We're going to make the interest. Now, we have to pay the insurance company's interest charge. No big deal. But it's a total of $106,971. It's not give up $9,700. It's keep $106. Not to mention we use this money to do the investment. So that's probably another, like we just mentioned, $15,000 on top of that because of what we did with the money.
Yeah, it's an investment. So we did it so we could make a profit and a gain. And now we'll pay taxes on that gain. But Jonah, we're not paying taxes on any of the gain of the policy numbers, are we?
Nope, sure aren't.
I don't even think we mentioned that to the group of people that we just debuted this for, and the world premiere of Use the F Word is there is no tax on the gain inside the policy. The dollars we keep or the gain that happens over time. No taxes at all. Read my lips. No new taxes.
There you go. So that was a little bit of our presentation from using the F word, the finance word, that we did for a group of clients in Nashville, Tennessee this last week. We went in more detail. We had some funny videos to play,
Yeah, for
right?
sure.
So it's an experience, actually. Anytime that we're going to be in front of the stage, there's going to be interaction. There's going to be laughter. There's going to be some fun reveals.
There's going to be some rewards, some giveaways. We're going to do it all, ladies
It's a
and
big
gentlemen.
deal. But most importantly, of course, there's going to be some teaching and some learning that's going to happen. Financing things privately, although it might seem like, well, it's all financing, it's all my money, you're not understanding the gravity of the situation if you think that, oh, just because I can go get a lower interest rate from Bank of America means I should do it. You're still losing the money. As Nelson says, you finance everything you buy. You either give up the ability to earn on your dollars, or you pay interest because you used someone else's. What we want to do is finance privately through properly designed whole life policies. The infinite banking concept teaches you all about that. You've got to understand, wrap your mind around it, and start implementing.
We look forward to having a conversation with you about this process. And we've got lots of other videos on the product of whole life insurance and why we're going to use that and all the ideals for that great asset. But this process and this overview, if you've been able to watch us and see us on YouTube, probably really transforms your mind around how much money you're giving away. We want that wind current to be at our back and for those dollars to stay inside our family. Now, a shout out to somebody who's learning this maybe for the very first time with our fan follow of this week.
Let's give a big shout out to Takesha Johnson on YouTube. She's got to Takesha Johnson and then some numbers after that. That's the subscriber number. I think they assign these automatically.
Do they? I have no idea.
Or maybe people
Who's running this? Elon or?
I don't know.
Larry?
Takesha Johnson 9680. Thank you so much for subscribing. Believe it or not, I think Takesha has reached out to us.
Wonderful.
Has asked us questions about infinite banking.
Yeah.
Has decided that she wants to be an infinite banker and is in the process of getting her very own policy.
Let's go. If you are in that boat and you want to join us, we're inside that a dinghy, a skiff, a yacht. We're pulling out, and we're going to take you with us, ladies and gentlemen. Join us on our Facebook page. Takesha's probably done that at this point. We have a Infinite Bankers Facebook page, and in there we've got a community of questions, a community of culture, a community of concern, because you think you might want to do it and you want to learn. So hit us up on that YouTube channel. Appreciate the subscription and also the Facebook community of Infinite Bankers. Answer the questions for us. We'll send you a discount code for a t-shirt, and we want you to join and get in the conversation.
There you go.
That's it for our episode on Use the F Word and a recap of some of the big basics that the families go through, like yours, all across North America, who are giving away way more than they keep. It's not about the rate, it's about the volume. Let's have a conversation about that very soon.